Boz, big one today, legislation changes, pretty exciting topic. There's talk of changing the way that capital gains are taxed.
Whenever you're thinking about investing in property, start with the end in mind. There's actually, like most things in the media, there's a bit more detail to these kind of policies than what first meets the eye.
A short-term investment in property to me is 3 to 5 years.
Yep.
You're ultimately buying for a 10-year growth cycle or longer. Welcome back to Brick to the Future. I'm Al Lewison. Thanks for joining us. Today's episode, I'm here with Michael Beresford. G'day, Boz. How are you, mate?
Great.
For anyone listening, hello@opencorp.com.au for any topics, ideas, suggestions or questions that we can incorporate in future episodes. Boz, big one today, legislation changes, pretty exciting topic. Pretty exciting topic.
Let's watch the page right.
All right, so we often talk about, and there's often these things that come out, the government's looking at changing things related to property because, let's face it, it's a big industry, big sector, and I guess something that drives a lot of revenue for the government and also a lot of wealth for Australians. So the one we want to talk about today is that there's rumours or talk of changing the capital gains tax laws in Australia. We might just talk about what capital gains is. Most people know, I think, but let's just touch on it. And then we'll talk about what the changes look like. So just want to explain to everyone what is capital gains tax and probably what is the discount on capital gains tax for holding an asset for a certain period.
Sure. So capital gains tax is, as you say, revenue generated for the government. You effectively pay tax on the gain that you've made in an asset, an investment asset. Your own home is exempt from capital gains tax. So probably the best way is with an example. Let's say you bought a property for 500K. Let's say you sold it for $1 million. Your capital gain is 500 grand. Now, if you've held that property for longer than 12 months, then straight away you get a 50% discount on the capital gains tax. So the taxable amount would drop to 250,000 from the 500. Then that effectively gets added to your income base for the financial year that you sold it, and therefore your capital gains tax, with some minor adjustments and disclaimers, so it's not dollar perfect, but generally speaking, you pay tax at your marginal tax rate on that taxable amount of the gain. So if you were taxed at 33% on $250,000 capital gain, then whatever a third of 250 is, that's how much capital gains tax you'd have to pay. If you hold that asset, again, property or shares for less than 12 months, then you no longer qualify for that 50% exemption and you pay capital gains tax on the taxable.
So in that example, you'd pay tax on the whole 500,
correct,
not the reduced 250 amount.
That's it.
Okay.
Yep. That
is capital gains tax in a nutshell. Talk to your own accountants. So the change they're talking about, and that's a really good example to use, and your numbers are really great to use because it probably helps us what we're about to talk about. There's talk of changing the way that capital gains are taxed, particularly for new property versus all other asset types, but new property.
Yep.
And what they're talking about changing to is the capital gains tax on new property changing to a 70% discount versus a 50% discount, and rolling the discount on old property, if you'd purchased it, back to, is it 35? 35%. So a pretty dramatic difference for people who want to buy a new property or are considering buying property and maybe aren't considering the full gamut of what the investment cycle is, that could be making a pretty significant mistake, because not only is there, and we're not going to talk about it today, enormous tax benefits up front during holding the property for being new, there now looks like or sounds like there could be enormous benefits at the disposal stage as well.
Yeah. So I think you, not today's topic, but just it's relevant. Whenever you're thinking about investing in property, start with the end in mind, right? And if selling a property in X number of years is going to be part of your exit strategy, then you need to be factoring in capital gains tax. Might seem simple and basic, but it's amazing how often people don't do that. So just wanted to get that out of the way early on. There's actually, like most things in the media, there's a bit more detail to these kind of policies than what first meets the eye. Firstly, if we think about why these proposals and recommendations or considerations come into the market, whether it be negative gearing being removed in the mid-80s, negative gearing coming back in the mid to late 80s, whether it be first home buyers, grants, ideas around CGT, all of these things, it's important to understand that they're typically delivered or proposed with the view of increasing housing supply, which is great for those people that have property. As I always say to clients, I like investing in something where I have the government on my side, because the politicians own property, we know that. they're not going to invest or table proposals for an asset class that's going to drop in value because they make too much money off stamp duty revenue. So that part. If we think about the CGT specifically, the detail is, because they're only talking about new and established, new apartments are qualifying for the proposal is that they would qualify for a 70% discount on capital gains tax payable. Brand new houses would remain at the 50%, and established dwellings would roll down to that 35%. So fundamentally, there's a lot of talk out there about the housing crisis. The 70% and keeping houses at 50% for new property is all about how they can increase the supply. When you think about, you talked about revenue before for governments, what would be the impact of effectively giving people a free pass or more CGT on new apartments? I think, when you look at that policy, apartments don't grow at the same rate as what houses do. And so they're happy to bump that discount up a little bit because in real dollar terms, the impact's not going to be as significant as what it is with land-based investment.
And tax incentives change all the time. And you talked before negative gearing and the changes in the 80s that came in and out. Yep. The unlosable election that was lost due to, what you can suspect is changes to negative gearing. But through all of that, in the recent times, and everyone's talking about it, they're not touching new property. They're always talk of changing it, but new property will continue to receive the benefits of it. And your point's really relevant. Around Australia, most capital cities are in housing shortage, undersupply. Vacancy rates show us that. Lots of factors show us that. So all these government incentives are driving, as you said, that increase in dwelling, increase in numbers to equalise out the numbers of dwellings for people. So do you think if that's stabilised, and it's a bit crystal ball here, and, the only time I could see them looking at altering that would be if there's an enormous oversupply of housing and they're bulldozing them like in Detroit back in the GFC. That'd be the only reason they could ever think about alternating some of those things back, because they need the housing growth. Yeah,
and government policy by itself around tax is not going to change the housing crisis, because these policies by itself, these policies can promote new construction and so on. Doesn't matter how many building approvals you have and so on. If you don't have the construction workforce to actually bring these projects out of the ground, then you don't get completed dwellings that actually fix the housing supply to begin with. So there's a lot of moving parts. We've had a few questions that have been, does this mean that there'll just be a glut of new properties in 2 years from now? The answer is no, because they can't actually facilitate them, or they can't get them through approvals quick enough. But yeah, it's important for everyone to remember that these policies aren't grandfathered, which means that if you make a decision today based on the circumstances today, then never in history have those properties been influenced negatively by these new policies. They only apply from a certain date that they're implemented.
So a short-term investment in property to me is 3 to 5 years.
Yep.
You're ultimately buying for a 10-year growth cycle or longer. I think a key thing to remember is governments are changing every 3 years. Governments are looking at how can I be re-elected, and governments are making policy on the fly to try and achieve that. So these things aren't written in stone. They're rumours and innuendo at this stage the media is writing about. We won't know till it passes legislation. I'm not sure it will. Mm-hmm. But I think it's really important, and probably the key takeaway for me is that everything they're talking about is to drive new property. Everything they're talking about is to get new houses built and create more accommodations or dwellings for people to live in.
Well, last year they came out with the Housing Accord, a commitment to build 1.2 million new houses by 2029. That equates to 240,000 houses a year, every year for 5 years. We've never built that in 1 year in Australia's history. We got close a couple of times. And we just don't have the construction workforce to do it. So this is what we were telling our clients 18 months ago. The government have since come out and said, yes, that's unrealistic. So, it's important to make decisions based on the here and now, not speculate about what might change or might not change. That just adds white noise to your decision-making process and keeps people from entering the market and benefiting from the uplift over time.
Great, Bowles. I think the key takeaways for me, go into your investment with the end in mind, whatever that might look like. You've used it a lot before. You don't get in a taxi, shut your eyes, be quiet and hope you get home. You tell them where you're going.
Yep.
That's your journey. Look at investing the same way. This is just speculative at this point. It's worth people considering, but don't make decisions. Thanks, Boz. Thanks for joining us.
No worries.
Thanks, everyone, for tuning in. Hello@opencorp.com.au with any questions, queries, or topics you'd like covered. Thank you.